Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? I'm the president of U.S. Advanced Computing Infrastructures Incorporated and also an investment advisor representative. We're registered in Illinois, and we're here to talk to you about not just our fund and the picks and what the data's showing, but also show you a little bit about how the market's performing and what's going on with the producer price index. So the producer price index data came out, which is, think of this as CPI, but for companies. I'll make it bigger for you. So CPI for companies, how did it do? Well, the first thing it did, prices declined in August and July, which is great. They've increased 8.5% for the 12 months ending in September, which is great. And the kind of core prices, less food, energy, and trade, advanced 0.4% in September. And so 0.4% in September overall, seasonally adjusted, 0.4 for the core. You can take a look at how the black line there is final demand. And so goods, about 12%, services, around 6%. So you're right around 9%, it's 8.5%. And you can see how it changed. And so let's take a look at maybe some of the specific data and see what happens. So if we look in September, energy actually is up 0.7. Foods are up 1.2. We noticed that at the grocery store, I'll be honest. In total, it's 0.4. So you can see food and energy drove it. Final demand services, you see transportation and warehousing cheaper. Trade services cheaper. It was other that went up. And so 0.4 is a little bit, it looks like an anomaly. 8.5% is a pretty big improvement. And core is flat, but it's improved from earlier this year. So the producer price index, it's pretty good data. It's okay. You can see how this black line, it was up, and it's come back down. And so that's nice. Let's take a look at how our stocks are doing. So this is our current CQ&S portfolio today, this morning. The top three and the S&P 500, those are our hedges. So if those are going down, the hedges are making profit for the fund. So it's either or. It's either the top three or it's the S&P 500. So if you're hedged with the S&P 500, you're losing money today in the fund. If you're hedged with the three down-run stocks, you take the average because they're the same size, and you're making money. You're making about 3%. Okay, feels good. So what am I losing? Well, you take a look at the stocks in the bottom, and these are high beta, high risk stocks. You have 8 of them. You can see the negative percentages. If I do a quick median there, it looks like you're at negative 0.8. And so, roughly speaking, you made 2.5 on the downside. You're losing 0.8. You're making 1.7% of your money right now. You're feeling pretty good. The fund is actually making a profit. Now, let's be honest, we don't like it when the S&P 500 goes up, but all the stocks that we're picking are going down. But as long as the down run goes down more, you make money. That's the value of a hedged fund. If you hedge it with strategic buys and sells, then you're going to do much better than if you just maybe hedge it with the S&P 500. We're noticing over time a little more volatility in the returns, but they're better when you hedge them with stocks that we think that you should avoid or short from our model run. I do think it's interesting that these stocks tend to be high beta, and the S&P 500 is up and the stocks are down. That is a divergence that I'm nervous about, because it says maybe there's a lot of focus and attention on the S&P 500 and maybe not so much on regular stocks. I do see that on the stocks that I hold personally, which I'm not going to discuss, that there's very little trading volume. Very, very little in terms of the book, right? The book is very shallow. So what that means is there aren't a lot of buy and sell orders, and in fact, the supplemental liquidity providers, the SLPs, the Goldman Sachs of the world, the FLTG, the VIRTs, the companies out there that actually get paid by the exchange to make a market in a lot of stocks, they're the ones with almost the top of the book, bid and ask. It's crazy in some stocks. So, all right, so we look at this for a while. We see that 3 stocks on the downside, 8 stocks on the upside, and the S&P 500. So how did we pick those? What's going on? And I'm looking, I have the 3 tickers on the bottom, the SPDR, these are all ETFs. The IWM for the Russell 2000. The SPDR is for the S&P 500. It's the Russell 2000. QQQ is NASDAQ. And just to show that this isn't really the top of the book because it's NASDAQ. It's, I want to say it's level 2 quotes. And so you're not getting the absolute top of the book, but it's close. And so here what you see is 2 cent spread, 3 cent spread on the S&P 500 with very few shares at the top. It's a very illiquid, very thinly traded market. Same on the QQQ, it was like 200 shares. Now it's 419. Now it's 300. It's very thin top of the book. This is it's concerning, to be honest. I look at this and I'm concerned because there's not a lot of volume. Hard to make a trade, right? It's not really that hard. If you got 100 shares, you can do it, right? If you had 1 million shares, right? You were trying to make some trades. Yeah, it's a little bit different. All right, so what else are we going to talk about? We're going to talk about, I guess I can look at FinViz for a minute. That's kind of fun. I'm always trying to figure out, what sectors are moving and how it's going. You could see the market is really flat within 10 points, the S&P 500. So that's 0.3%, and that's because the inflation reading, actually the Federal Open Market Committee and the Federal Reserve Board's meeting minutes from last month are coming out today. So I don't care about that. The market will care, trust me, but I don't. So if we take a look at the market, interest rates must be rising because interest rate sensitive stocks, telco, real estate investment trusts, utilities, they're down. Interest rates must not be up very much because the banks are doing okay. Capital markets are doing okay. Insurance, asset managers, a little iffy. And so and you got your semiconductors, tech, kind of weak. So interest rates must be up a little. If we look, it looks like interest rates are actually down a little because the bonds are all up. If this is accurate and current, I have another place we can look. Let's take a look at the 10-year. We'll just focus on the 10-year. Yeah, it's down 1.1 basis points. Down a basis point, right? It's not a big deal. The 10-year Treasury looks like it was up earlier today. Came back down. Looks like it's coming back up. So basically no change in interest rates. That's good. So earlier today I sent out a tweet and I said, beta, high beta stocks. Beta over 2. And we could do beta over 1.5. That's fine. Maybe not so crazy. Descriptive. Stocks that are over $2 billion. And let's see, shares outstanding. Over 100 million shares outstanding. So we take a look, and here there's a lot of red. Okay, there's 10 pages to flip through. Here, more red than green. More red. More red. More red. So a beta of 1.5, pretty high here. Oil and gas, green. But that's okay. So your high-flying oil and gas are up. Oil and gas. But in general, there's a lot of red. Now let's take that beta and let's take it up to 2. And now we see it's much more red. There's only 4 pages of it. Except for oil and gas, right? Exploration and production. Even some of the oil and gas is down. Down. All right. XPO is up. That's interesting. I like XPO. So lots of negativity out there in the high beta stocks. Now our model likes high beta stocks. So let's go back, take another look. So you were 8 up, 3 down, and the S&P 500 as a hedge. So let's show you some inside baseball. Let's look at our down run. Now we turned the risk a little bit higher in our model last night when we ran it. Oh, don't make a video of this because this is all confidential. So no videos, no recording of anything we're talking about here today. I asked that as a friend. You know. All right. So the first thing to look at is the S. By the way, I'm recording it. That's a joke. I hope you liked it. The S&P 500 variance is 0.001979. So think of that as 2.0 times 10 to the minus 4. Okay, that's a healthy variance for the S&P 500. I'm just telling you. And in fact, a year ago it was at 434. Now it's at 357. When we ran it at market close data, now it's at 359.08. So 359.03. So in fact, the S&P 500 is up today. It's good to see. We take a look at the actual year-to-date returns. The S&P 500 is down almost 18%. Now, it's probably worth taking a moment. It's down 18%. So, Jeffrey, what does that mean? Why do you... What? Right? What? Hey? What's eating Moive? Eh? Well, it's down. But it didn't start falling a year ago. In fact, it started falling in December of 2021. December 1st is when it hit the peak. So we are about 10 months. So if you go back to like October 1st, you were down before the peak. So what's interesting is that it's gonna actually show a larger year, kind of 1 year decline. And then eventually it's going to ride back out. And so we're getting to the point where we're done with the peak. And we're almost a year. So December 1st, October, we're 10 months of declines. And so that's tricky, right? But you had March to December, you had 21 months. 21 months? Yeah, 21 months of ascent, of market going up. And so, yeah, we don't know where the market's going to end up, but it sure is interesting to see that over the past month, it dropped, it started to settle in, rose, dropped, starting to settle in. Who knows? Could drop again? Like here, see how it settled and then it dropped? A lot of it depends on interest rates and what the federal government does. So, we don't know. All we know is market's down. It's down even more for the Russell. It's down even more than that for the NASDAQ. So tech stocks, right? So a couple things. We have a $750 million market cap threshold. We have minimum volume every day for a year, 50,000 shares. The stock cannot be more than $10,000, and it can't be less than $1. Okay. 11,174 stocks traded. We validated down, and this is our down run. This is our down run. This is our down run. We ended up with 480 stocks. And this is interesting because the variance of these 480 stocks that lost money they all had negative net income. Now this is 6.65. It's actually 6.7 times 10 to the minus 4 variance. If you held all 480 stocks evenly for the year, it's interesting. So much higher variance, 2.2 versus 6.7. That's 3 times the variance of the S&P 500. All right. So what we do here is we run them all. And these are the worst of the worst. And so a lot of pharma. Then the first one that is not pharma is desktop metal. Uh-oh. Don't do that. Right. The first one that is not pharma is desktop metal. Then you keep going. And then this. And then this. And then you got the old faithful names. Peloton. Snap. Still a lot of pharma. And then I don't know what a lot of these other ones are. I know Tellurian. They're trying to do a natural gas export facility. I know Canopy Growth. It's pot stock. I know GameStop. I know DraftKings. I kind of know W&T Offshore. I think they're a services company, oil and drilling service company. Tenneco always surprises me. And you got Roblox. And you got IonQ. And so when you look at these stocks and you take out the biotechs, just pull them out. Then what do you get? I'll pull out the stocks I don't know. Well, I'll leave Forge Rock. I think, Maxion Solar Technology. I don't know what half this stuff is. All right. We'll take those out. So these are your dog stocks. These are high risk, low expected return. You might say, wow, Jeff, thanks, man. I own no stocks. Right? You're not very nice. I'm not saying they're going to go down. I'm just saying that you shouldn't hold them. Because they have high risk and not a lot of return expected. That's it. Or the expected return outweighs the risk. So, Desktop Metal, Everbridge, AMC. Not Axome Therapeutic. No biotech. And then you got Peloton, Snap, Maxion, Forge Rock, Tellurian, right? Canopy Growth, GameStop, DraftKings. I don't know what they do. Tenneco, Roblox, Wallbox. Oh. IonQ, and NVX. Novix Corporation. I don't even know what Novix does. I'm going to take it out. That might be a biotech. All right, that's it. Those are your down stocks. So you got to decide, how are you going to hedge? Are you going to hedge with these, or are you going to hedge the S&P 500? We made a decision to do both because we're paper trading it to see what works better. And then when we start putting real investor money in, We may even give our clients a choice. I'm not sure yet. There could be two different ones. There could be beta weighted spider or 3 down stocks. I personally like the 3 down stocks concept because it uses the intelligence of the model. So this is your down run. Now there's a lot of other stuff in here. What's relevant? I got solver results. I got all kinds of good stuff here. But what's interesting? There's a couple things. Let's look at the beta, negative beta stocks. I know some of you like to talk about beta, right? So there is one negative beta stock, Biohaven Pharmaceutical Holding Company. BHVN. That is a negative beta stock. Okay, cool. Thanks, Jeff, for sharing that. I don't know that you should do anything about it. The other is, here's the companies that paid 5% or more in actual dividends last year. So they lose money now, but they still pay a dividend. So New Star Energy, limited partner. Sabrina Healthcare REIT, a pipeline company, which does not look like a master limited partnership, but might be. This looks like a business development corporation. TELUS is a phone company. Tell us something new, Jeff. And this looks like a capital, like an investment company. And then there's another limited partnership. So limited partnerships pay out earnings, pay out dividends, distributions. And in this case, they lose money and they pay a distribution. That's pretty nice because you get the tax break on your taxes. I'm just saying, that's nice. So, betas. Who are the highest beta stocks? So, money losing. Affirm, Mara, Carvana. And you see Carvana trading all the time, right? So, high beta. You see Riot Blockchain. So, more Bitcoin, right? Marathon is Bitcoin. Bitcoin is still dominating the high beta stocks, which I find really fascinating. I figured that Bitcoin was over. I thought Bitcoin was over. It's not over. It's not over. All right, so you got a couple Bitcoin stocks there that you can look at. And so that's our down run. Now, I don't know if you're interested in hearing about the up run, right? How did we come up with the stocks that we picked? Or maybe we just stop here. I showed you the down run. I showed you a lot of that stuff. And then we move on from there. Some other interesting data points, right? These are stocks that fell really fast. No stock in the past year rose really fast. They just fell really fast. The bias is on the downside. Here's stocks that split. You can see Fortress. Split, that's one of the ones that's paying a high dividend. You see a lot of high beta stocks. It's interesting. And then what we do is we produce a spreadsheet with this. It gives you a lot of information about the stock. So if you were actually a client and you were buying a run, as we call it, you get the spreadsheet. So you find out that for Desktop Metal, now a negative CQ&S score in this case, because it's a down run, is bad. Right? Expected return is almost 16% on this stock. This stock, that's a lot of expected return. It's expected to go up 16%, Jeffrey. The volume is only trading at 38% of last year's average volume. It's down 40%, 40% and change. The variance is quite high. Now, if you see it on the good stocks, it's like 0.01 or 0.00 something, right? Here, very high, and no dividend paid. So that's interesting. That's Desktop Metal. And you could learn a lot about some of these stocks, right? AMC, Everbridge. You could see what the expected return is, whether you should hedge it. You could see whether this is a low volume stock or a high volume stock, right? These are low volume stocks. We are using these as our hedge, and they're low volume stocks, which is fascinating. Now, Peloton just dropped out, Snap dropped out. Those are higher volume stocks. And so, yeah, I guess the model, right, likes the low volume stocks because they're kind of, maybe they're more jerky, they're more jittery, right? So, all right, well, that's interesting. That's our down run. So that is the up run. I'm going to leave it sitting there, and I'm going to try to figure out what else can I show you today that's interesting. I guess if nothing else, I will show you the up run a little bit. Again, always finding it interesting. So Biohaven. So we see the S&P 500, right? It's still up today. Current portfolio today. Oh. So two of the longs are starting to go up. The S&P 500 is starting to go up more. And you still have a nice healthy decline among the three shorts, although that decline appears to be reducing. So here you have a situation where the market is turning upwards. And you can see it, the S&P 500 up over 3,600. So the question now is, like, what's the news, right? What's happening? Why did that happen? So the first place I like to look at is I go right back to the 10-year bond and I say, hey, maybe interest rates are coming down. And they are down 2 basis points. So, hey, Jeff, what about shorter rates? Let's look at the 1 year. Flat. That's okay. It's okay. Talk to me, Jeffrey, about the 30-year. It's down 3 basis points. Jeffrey, talk to me about TLT. TLT is up. So that means rates are down on commonly held bonds that are used in that fund. And so it's interesting. This is very interesting. First off, I love it, right? You can't, you really can't beat it. You can really see what's happening here, right? And so that, by the way, I just took a picture for the thumbnail. And so that's up. So bonds looking up. Now that's going to make banking stocks look a little bit healthier, right? But sticking with this, so now the question would be, did the where is it's okay. We're not gonna worry about it. See, take a last look at FinViz. Take a last look at CoiFin. We can see where the market's been moving, right? For the 1 day, keep the Russell in, take the Dow out. You see the VIX is down. You see the market is starting to turn positive, which is nice. And you see consumer staples are leading the charge on financials, and that's got to be because interest rates are dropping. Even, utilities, real estate, really, really tough right now. And so we'll see. But fixed income, you can see it. Corporate credit ETFs, high yield is up. Treasuries are up, the ETFs. Tips are up. Municipals are up. So we're looking okay here. Today is not a crash day. Now, again, the FOMC minutes we go to federalreserve.com, meeting minutes, January are here, March are here, May, June, July, September. So just to remind you of what happened in this meeting in September, which was very, very, very bad for stocks, just so you know. So this is what happened in September. By the way, keep your eye on the S&P 500. See if that crosses over 360. That's a big point right there. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. So they raised federal funds rate to between 3 and 3.25%. Three and 3.25%. Reverse repo, overnight reverse repo agreements, reverse repurchase agreements, 3.25%. So that's a lot of money to be paying out. They're going to roll over principal Treasury securities, anything over $60 billion a month. They're going to reinvest anything that exceeds a cap of $35 billion a month. So what that means is that mortgage-backed securities today, probably not a lot of people are paying off their mortgages early because most people don't have the money, and they're going to refinance when they repay their mortgage. You don't refinance when mortgage rates go up. So I think the mortgage-backed securities are not really rolling. What's interesting is that they can really they can pay down $35 billion a month, and then the treasuries, it's basically they're reinvesting anything over $60 billion. So they're removing $60 billion a month of paper and $35 billion a month of paper if it happens. So that's $95 billion a month of paper maximum off of their treasury balance sheet. And so it's a 0.75% increase in the primary credit rate. So the question is that going to go up to 3.75 or 4? So people want to read the note and they want to see, is it another 0.75% increase? I don't know. Maybe. Don't know. But we're going to find out. We are sure going to find out. And the meeting minutes are from September 21st. So that's how you should think about it. And so, yeah, that's interesting. Let's go back to holdings of our fund, right? So you see the top three. I see the top three are still in good territory, right? They're still losing money, so we're hedging with those, so we're short those. And then on the bottom, these bottoms, we would be long, and so you see two are up, the majority are down. What's interesting is, again, the median, which is the fourth one, is down 0.23. So actually the fund is making a lot of money today because the hedges are paying for the reduction in the longs. And again, interest rates down 3 basis points. That's interesting. You're up 0.35%, 35 cents. I guess you call that 3.5 basis points. And that's where we are today. And let's see. Well, I want to thank you very much for watching. If you liked the video and you found this was interesting and you like learning about the stocks and the down run and all that, you can check out our website, which is chicagoquantum.com. You find out that we're registered investment advisors. We're also involved in the quantum industry, quantum computing industry. You can look at our research and you can see a lot of research in there, free, that we share, that we update. We also are running a market test of our fund. And so we post almost every day about how we're doing and what we're finding. And so, in fact, this morning, October 12, we increased the market risk by 0.5% market expected return. And that's interesting. Our expected return over a year is now 9.5%. The risk-free rate, which is like subtracted out, kind of, if you do the math, is 3.75%. And so we cut our long investments by 40% by doing that. By being more risky. More risky means fewer stocks. Fewer stocks means less diversification, more risk. But we didn't increase the size of the holdings, and so they're all even. And so that it's got a lot less. But what it also means is we unwound a lot of the hedges. And so that's what's going on. We also swapped out of one of our down runs, changed our market cap threshold. Well, NVIDIA is interesting. So NVIDIA is actually showing as being a better stock than the S&P 500 equity index on a risk-return basis, expected for the next year. And so if we were to look at this stock on a daily chart for a year, clear the line, and let's take a look, you would see the stochastics over the year show a lot of up and down, a lot of flow up and down. Looks like it's more down than up. And effectively, the stock is flattening, right? The amplitudes of the moves are happening faster, and there's a lot of flat. And so there's a lot less risk. Now the stock is moving with a beta of greater than 2. I want to say, if I remember right, it's like 2.25. So you're getting a lot of S&P 500 movement, amplification, but it's really damped down. And so this is a stock that's starting to coil like a spring. And eventually, if the market turns and the market goes up, the stock should pop up higher. Right? So the model likes it. I believe it pays a small dividend, NVIDIA. That 0.14%, so it's tiny dividend, but it pays a little dividend. Here the beta says it's 1.7, but I believe it's actually higher over the past year. It's like 2.25. And you can see the stock has been as high as $346 a share. And it is down near its 52-week low. So our model loves NVIDIA. It's the favorite stock, long. And so just showing you kind of where the model takes you. So again, thank you very much for watching. If you like the video, hit the subscribe button, drop a comment. If you're interested in learning more about the fund, reach out via the website, chicagoquantum.com. And we are not yet taking investors because we're setting up our custodial services, which we've outsourced to Charles Schwab. But once that's all set up, we'll be ready to take client money. And so we're working on the brochure and the fee structure and all that kind of stuff. But give us a call, and I'd be glad to talk to you. How do you reach me? You go to the contact page. That's what I look like. At least that's what I look like in a suit with a little facial hair. And you see a phone number, email, mailing address, Twitter feed. So if you like that kind of thing, you can go follow us on Twitter and see what we like to talk about. Oh, look, we updated our Chicago Quantum Net Score model to be slightly more risky last night. Fewer stocks, still 100% hedged. I'm trying to give out as much information as I can. We don't promote our tweets. And my guess is, 37 people might have seen it, scroll by in their feed, and probably not one person cares. So, but that's okay. And we also try to tweet out things that are relevant, like high beta stocks are lower now, which is interesting. We found it, thought it was interesting, wanted to share it with you. So, all right, take care. Hope you enjoyed the video. I'm Jeffrey Cohen, Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated. And again, hit the subscribe button. If you like it, you get notifications of future videos. Take care now. Bye-bye.